we've had the most cash we've had in many years, actually. And so by the time we got to, let's say, May, June even, if you look at what we think are going to be the numbers for companies over the next 12 months, then it's hard for us, again, to see any great value. And I'll tell you why. Once you decrease the earnings, you have to decrease your expectations and where you want to own a company. And so we have very, very few companies that really fit into a category where we would want to start buying heavily. So we're sort of like we were. We're just at a sort of a downslope revision of it from a year ago. As a group, they were down 10% in earnings from a year ago. So that's the kind of thing you start to see now. We own a lot of other things besides, that's not a big area for us. But I will say that what we're finding on companies in general is they're starting to announce now that we're not going to hit the number, or they've decreased their expectations so people will think they beat the number when they really didn't. If you go back 6 months from then, they didn't beat the number at all. And that's where we are in the stage of things. And I think there's more of that to come. And so for us right now, what we'll do is we're sort of at a waited out type thing. I think people have to wait this market out or they'll make some mistakes. Well, I think the cost thing overall, Jack, is happening to every company, not just those stocks. But those stocks, if you'll notice, a lot of their advertising revenue is down. A lot of people going to their sites are down somewhat. And we don't own this stock, but if you take Netflix as an example, okay? People go on, they take the service, they watch the 2 shows they want to watch, and they drop. And so, it's that kind of thing where they can't really keep that consistency up. So I think that's where a lot of companies are headed in here, where their numbers just won't match up. One of the things that we say and right now is that, if you look at the last 12 years, there's all these people in the industry that have never been through a slow burning bear market. I've been through a lot of them, a number of them. So what happens is you have a break, you have a rallies, and then they roll over and they go a long period of time with a drop. They don't just crash, they just eat away at you over time. And I think that's where we are now. And I really suspect that the next 3 to 4 quarters will stay under pressure. I'm not saying you won't get any rallies, you certainly could, but I think if you just look at the headwinds here, we're going to be in a place where it's going to be tougher.
How long do you think the bear market will last? And does it remind you of any periods you've seen throughout your career? Let's see, there's the 2008 bear market, there's the .com bust, and then there are many priors, which are also examples.
Well, the difference between this and say 2008, for example, is this market was a super bubble market. I've never seen as many things in the last 18 months that were so expensive, and not just stocks, but I'm talking about bonds, private equity, private real estate, you name it, SPACs, crypto, I could go down the list, everything was in a bubble. And that's more like 2000 or 1973, January, more like 1929, where you stay in the bear market longer than normal. The people that have been around this last decade, 10 or 12 years, they saw a bear market for about 40 days in March of 20. And so it's very hard for them to get their hands around this, and that is, okay, this could last a long time.
For equities and risk assets in general, what would it be? Would it be the economy? Would it be the Federal Reserve or something else?
Well, the short term, Jack, would be Federal Reserve, yeah, but I don't think that'll be the long term. In the long run, I think it will be the economy, because what will happen is you'll have somewhere along the line, you would have probably 2 quarters of reasonably significant downturn, where it would get into we haven't gotten into unemployment yet, but when unemployment starts rising, you get into that's when you're in a real recession. And so we haven't gotten that yet, just barely touched it, but once that starts and gets deeper, then you're in a real recession, and then you're in a situation where companies are going to really have to adjust out earnings, et cetera. But that's what makes a low. I mean, there's opportunity in that. I wouldn't necessarily be so negative about it, but I think you're going to have to get into that for a couple of quarters before it's all over with, I would say. Those will be hit harder, I think. I think those will stay under pressure as you go along. I think a lot of that has to be wrung out of the market. And then you had so many companies, Jack, that really didn't make any money. Some didn't even have any revenues, and people are hung up in them. And I think all of that has to be wrung out. You already see it in the SPAC market. You see so many SPACs that are down 90, 95%. I think that that's started, that's a big hit. Probably crypto has a long way to go, but all of those speculative excesses will have to be wrung out of the market till you get to a point where people are just basically disgusted. That's when you get a low.
And you think we're nowhere close to people being disgusted now?
I don't think so. I think it's a way, and you've got a longer to go, I should say. Maybe, it could be wrong, or maybe there's a saving grace out there, I don't know. But if you look at Europe and the Far East, and if you look what's going on, it could be a tough winter for a lot of situations. And so I can't see that right now. We have 3 strategies, but if I'll just take the most conservative strategy, which is really just called conservative income. And we have probably 75% of that strategy is within 36 months or so of maturity. And we got a lot of heat for that last year, but we felt that's where we should be going with it because we could see rates were going to rise. And so, you can get some really great yields right now on 6 months, 12 month, 18 month U.S. Treasuries. And secondly, we have a 7 or 8% position in the longer bonds. We won't add to that right here, but we've always had it, on the outside. And then in between, we own a number of things that pay some really great cash flows in that strategy. And we have another strategy called high income. We own a lot of the great preferreds and some convertible preferreds. We're getting 6, 6.25%, 6.5% on all of those. We own a couple of medical REITs that are really great yields for us. We own a good convenience store REIT that does well for us. And all in all, we try to pick and choose. We have about, we have a small percentage, 4% or so in gold miners and gold. And that's where we are in sort of those 2 categories. In the stock side, there's still some stocks that we think we own and we think they'll do reasonably well. We're only about 48% invested in stocks right now. But if you look at what we do own, we own Visa, MasterCard. Those are kind of companies that will continue to do okay even in rough times. People will continue to use their cards, do things along that line. O'Reilly Automotive. We have a lot of things. We try to buy things that you're going to use no matter what. During this period. So that's sort of where we are at this point.
What else do you see as not recession-proof, but recession-resistant sectors or stocks?
If you get the right real estate, and you have to be, when I say the right real estate, it has to be the parts of the market where that they're going to need what you have. That's why we have primary medical. We don't see, but if you use demographics and you use the things that go into that, we think that's an area that while it could be somewhat affected, it's usually not affected much. You don't find many physicians' offices closing down because times are tough and that kind of thing. So that's an area we really still like. We obviously think that's fine. If you look at natural gas pipelines, their throughput is there no matter what. So, you're going to burn natural gas. You may be burning it at $5 an MCF or $10 an MCF, but you're still burning it. And that's why we like that group quite a bit. In the common stock area, what happens is a lot of the growth stocks that, we might look at and say, maybe this company could grow at 15% or 16, 18%, what we would like for it to. We've had to reduce those down. And when you reduce them down, you got to buy them cheaper. And that's where we are. We'll buy the energies again too. We own them now. The energies, but we'll see where it goes from here.
How are you thinking about credit risk? So you said you have a conservative income fund. You have a lot of 6-month, 12-month treasuries. That is essentially a risk-free treasury because the treasury will not default. There can be inflation, but it will not default, unlike a private company. What about those, high-yield investment-grade bonds or maybe commercial paper? Are you seeing any opportunities there now that the yields are higher? And also, can you comment on the spreads? That is the yield minus the treasury, so the spread relative on top of the treasuries. Have those widened to a level that you're attracted to them?
Well, they have widened, Jack, but what happens is, and we've always tried to mention this to people, when you're buying high yield or what we call junk debt, it really equates to the same as a stock.